if not filling it out completely. Plus, when you load up the question again, the numbers will all be different anyways.
Where does the sales revenue come from?
Sales revenue is units sold times
Okay.
unit price.
Got it. Alright, thank
Yeah.
you.
So it grows every year because the unit sales price grows every year.
What about if you, how would it be if you, expect your sales to grow?
You could model anything really. So you could model that. I could say that I think my units sold are going to grow at 2% a year, and my unit sales price is going to grow at 5% a year.
Okay.
So I can model that in so that this number increases too. It really depends on
Okay.
what what your marketing department and your sales folks think is going to happen.
Okay.
Okay,
Marketing, is marketing in charge of having those expected
so
values?
you're going to have to talk to your marketing professors about that. I don't know.
Okay.
I just run numbers.
Okay.
And,
Question.
yeah.
When did you get the initial sales revenue for year one?
The initial sales revenue from year one, still I was given a unit price and a unit sold, so my revenue is just going to be those two numbers multiplied. Does that answer the question?
Yeah.
Yeah, sure. Okay, tricky part here. Everybody,
Yeah, we're
this is where everybody gets lost, so make sure you pay attention here. Okay, net working capital.
Yes.
My net working capital needs are 11%, based on the question, I'm told it's 11% of my sales revenue from the project.
Yes.
So that's how much it's going to, that's the level that it's going to be at, right? So it's net working capital this year, in year 0, is sales in year 1. Net working capital in year 1 is sales in year 2, et cetera, et cetera. Yeah? Okay. So sales times my 11% estimate in this case, yours will be different. I'm going to lock in the reference to 11%. Drag it across. So now it's next year's sales times 11% is this year's net working capital, et cetera, et cetera, et cetera. Notice what happens. This is this times this. This is this times this. On and on. Notice what happens in year 4. My net working capital requirement is 0, right? Because the project's done.
Okay.
So I don't have any new net working capital requirements. And in fact, it's going to reverse as a cash flow, but we'll get to that part in a minute. But this is my level, right? Make sense?
Yeah.
Okay. My basis for depreciation, there's no tricks here, this is just the 12 million equipment costs. I'm not told anything about installation, transportation, none of that stuff. I don't have to add anything together, it's just given as 12 million. That. Oh my God, Mackers. Okay, so the Macker schedule here for depreciation. This equipment has a 5-year Macker schedule. Yeah? That means that it's not going to fully depreciate in the 4 years of this project. So I'm going to end up with some book value left. I know that because it's a 5-year schedule and a 4-year project. That's going to create some situations with my taxes. Good things, mostly, but I want to explain why the numbers are different than the scenario we looked at before. So here's how you do this. The annual depreciation expense is the Macker's percentage times the basis, right? So the first year I get to depreciate at 20%. The second year I get to depreciate 32% of the initial basis, not the new value, but the initial basis, et cetera, et cetera. So I'm locking in my D25 reference. Nope, locking in my C24 reference. Sorry about that. Because C24 is the basis, right? So I'm going to lock that reference I'm gonna drag this across over the 4 years. In year 2, my depreciation expense is 32% times 12 million. In year 3, it's 12 million times 19.2, and then in year 4, it's 1.3824. Just so you've seen it, I'm gonna sum up these numbers here. And it's not really one, it is 83% basically. I'm depreciating 83% of this 12 million. Which means I'm gonna have 17% left on the books, right? So the next line here asks me for the ending book value. It's asking for the ending book value at the end of the year. That is gonna be the initial 12 million minus the 2.4 million I depreciate in year 1. In year 2, it's gonna be the 9.6 million on the book at the end of year 1 minus the 3.84 million I depreciate in year 2, etc., right? Which means at the end of the project, I have a cash value, or on the books, I have a value of 2.0736. I can only sell this, in my question, it said that I could sell it, the equipment, for $600,000. But that's less than the book value. So what does that mean for my tax expense here? Remember in the example we did 2 weeks ago now, we actually got all the way to 0, right? So when we sold it for something, we had to pay taxes on that. But in fact, the book value now is higher than what I can actually sell it for. So it ends up being a tax benefit to me. So I'm going to plug in my salvage value here. It's given up here as 600,000, right? The profit or loss on the sale of the equipment, this is what I'm reporting to the IRS. I'm losing 1.4736.
Oh, right.
So that's basically, I'm calling that a loss, right? I get to report that as lost income, right? I made an investment, didn't pay off. That's cool. I get some credit with the IRS for that, right?
Okay.
Happens to me all the time, unfortunately. All right, so we lose money on this equipment. This becomes a tax benefit to me because I can, remember, this is part of a bigger company, right? If I have profit somewhere else, even in this project, but it's definitely somewhere else, I get to claim this as a tax benefit. It is not a cash flow though, right? I don't actually have to spend this money. All I'm collecting is the 600,000 plus whatever the tax expenses I save, right, tax benefit. So the tax on the profit or loss is going to be this times my tax rate of 25%. And my net cash flow due to the sale of the equipment is the 600,000 minus whatever my tax expense is, but in this case it's a negative number. So in my example, it's 968,400. That's the cash flow for my sale of equipment in year 4. Does that make sense?
Was it?
What happened? Yeah, I know, it's kind of confusing.
Loss. It's minus the profit or loss?
Excuse me?
It was the book value minus these.
To calculate this was 600,000 minus 20736. So that's the loss, right?
Tax and profit.
Normally, in the situations we looked at before, it was actually, our salvage value was greater than the book value, in which case it would be a profit at that period. But in this case, it's less than that, so it's a loss. So that's why it's a negative number here. And then I take that number and multiply by the tax rate to get the tax benefit, basically. So rather than paying taxes, I actually don't have to pay taxes on some of this.
Okay.
I actually get some, actually even get it back, right?
Oh.
In a cash flow sense. So my net cash flow is this number minus this number, but this is a negative number, so it ends up being more than
Like
this
it's
number. Everybody good?
Yeah.
Alright.
I have a question real quick.
Shoot!
Will you, I know you record all these sessions, will you post this one so, like, 'cause I don't move very fast on Excel, so will I be able to, like, go back through and make sure I understand everything?
So I haven't been able to post anything since the system shut down. I record them all just in case we ever get a solution, but I haven't been able to do it. So I would say yes, but I don't know that I'll be able to.
Okay, thank you.
Sorry. Hopefully, so Kyle, if you're following kind of the understanding, you don't have to necessarily follow me every step of the way, just kind of try to understand what's happening here. And the homework itself, the assignment itself, will let you check your work, right? So you can check at every stage to make sure that, oh, I'm getting this number right or I'm getting this number wrong. And if you have any questions, if you hit a wall, just shoot me an email and I'll respond.
Thank you.
Okay, so this is kind of nothing. I mean, some of this is on the income statement or generates toward the income statement, but it's sort of separate from anything we would calculate there. This next part here, the cash flow forecast, a little more like what we're looking at on an income statement directly. So we're going to fill in some numbers here. Sales revenue. Stutter a little bit here. Okay, so sales revenue is, we've calculated already, right? We're just going to point at our sales revenue number from the units sold times unit cost. And we're just going to drag that across. So we're just pulling that number from here, right? The variable cost, same thing. We've already calculated. We're just pulling it up here. No, I'm lying. Sorry, we haven't calculated yet. So the variable costs are actually going to be the unit costs times number of units sold. So that's going to be the full variable cost. That should make sense though, right? You've got, if this is how much we sell each unit for, this is how much each unit costs us to produce. So the full variable cost will be those two numbers multiplied together.
I thought we had the variable cost of the intermediate calculation.
We did this per unit.
Oh,
And then, yeah, so we went from a per unit cost to the full cost. Yeah, I thought we had two actually. So my mistake. Okay, so now I've got the variable cost, excluding depreciation. Just drag it across, should be the same references here. Multiplying unit sales by variable cost. I do need to do it for every year because those variable costs are increasing it with inflation, right? Now, non-variable costs, that's also called fixed costs. So that I can just point at these numbers we calculated before. Dun-dun-dun. And finally, I have my depreciation expense. The reason I care about my depreciation expense is because this is what I report to the IRS, right? I get to claim this. I get to take it out before I pay taxes. So to calculate my tax expense, I have to do this part. I'm just going to add it back in at the end, but I do have to do this for tax purposes. So depreciation, I'm using this annual depreciation expense line here that I calculated before. And I'm going to drag it across for all 4 years. Yeah? Any questions?
No.
Okay. Once we've got that all correct, I can calculate my operating income before taxes. So basically EBIT. I do that with sales revenue minus variable cost, minus non-variable cost, minus depreciation. That's my operating profit.
Okay.
Drag it across, should be set. This is what I pay taxes on though. So I'm going to multiply this number times my tax rate. I'm gonna lock that tax rate reference in. And figure out what my tax expense every year is. This times 25%. This times 25%. That allows me to calculate my NOPAT, my net operating profit after taxes, as operating profit before taxes minus taxes. This is my
Can you go
NOPAT.
back to the taxes, please? Just to see.
No, I'm done with taxes.
Okay.
Sorry. So this is this number here, right?
And tax.
The, what do we call it, the operating income before taxes? And I multiply it by the tax rate up in the given information. So on this next row here, I'm just subtracting operating income from the tax expense, and I end up with my NOPAT. That's not my cash flow though, what I want is my cash flows. My cash flows are NOPAT plus depreciation expenses, right? That's my operating cash flows. Because remember, I spent the 12 million for the equipment in year 0. The depreciation that I get to claim over the life of the project, not actually an expense. It's already spent in year 0, right? So in terms of cash flow, that's why I'm adding it back in. Yeah? So net operating profit after taxes plus depreciation expense gives me these, what we call operating cash flows. Yep, all right. Now, next line asks me for equipment purchases. That's just the number that I had from before, the 12 million. I'm just gonna reference that cell. If you wanted, you're gonna have to make this a negative number somewhere. If you wanna do it now, you can. If you wanna do it when you get to totaling up the cash flows, that's fine. But this was 12 million I spent. So it's not a positive cash flow, it's a negative cash flow, right? I'm gonna go ahead and do it like that now. So we can see I spent the 12 million on equipment. Now, change in net working capital. I calculated the level of net working capital, right? That's how much I'm gonna have in those accounts. Current assets minus current liabilities. What I actually care about though, from a cash flow perspective, is what is the difference in those values, right? How much do they change year to year? I may have to increase my inventory, for instance, to make this project work. That's a cash outflow, so I have to record that, right? So the way we're gonna do this, these are gonna be negative numbers, right? If it increases, then it's a cash outflow. So I'm gonna put a negative number here on that first one where I had to raise it to get this project started. Full-blown expense, right? 3.267. What I care about now is how much it changed. So as it increases over time, in year 1, I'm looking at how much is this minus how much is this? The year 0 net working capital minus the year 1 net working capital. That's a cash outflow of negative 163,350. Then same thing again, year 1 minus year 2. Cash outflow of 171. Yada yada. In year 3, it's the year 2 number minus the year 3 number. And then in year 4, this is where it gets weird, it goes to 0. So this is this number, the formula is the same, right? It's still 3781961 minus whatever the year 4 number is. But what happened is I'm able to let my net working capital reverse. And therefore that becomes a cash inflow. Because the project's done, I can let it go back to where it was, and I get to collect all this cash. basically, you can think of that as selling down my inventory, you can think of it as releasing the cash that I was holding to make the operation work, whatever, however you wanna think of it, but when you have an increase in net working capital, often it reverses at the end.
Okay.
And then finally, we have the net cash flow due to sale of equipment. This is this value, and it was positive, right? I get to collect 968,400. Oh my God, we haven't even gotten to the hard part yet. Okay, so now I'm gonna sum all these up. The full project is, really, I can do it like this, just sum up, nope, not all of them, sorry. Sum up all of my operation, these are my operating cash flows, this is my equipment cash flows, this is my net working capital cash flows. I sum up those three cells, and I should get the full cash flow for that period. I'm just gonna do the same thing for year one. Let me check my numbers here, just make sure I got this right. I'm missing.
Column G, you're not capturing the net cash flow from sale of equipment.
Yeah, you're right. Thank you. Sorry, yeah, I got things, that's correct.
Sí, yo también me pasé por
All right, any questions? Got your cash flows? Now we have to do, the next part of this is NPV and IRR. The NPV function is equals NPV, find the rate, so we have a weighted average cost of capital of 14%, we know that that's our discount rate for this project. And then we go to the future cash flows. Remember, we don't select the first outflow, we don't use that equipment purchase, we're only using the future values. And we're adding back that initial investment amount. So I got an NPV of a little over 6 million. We take the project?
Yeah.
Yes, because it's positive, right? Okay. Any questions on that? IRR is even easier. We just use the IRR function, and then we actually do have to point at that initial cash outflow. So I just pick the 5 cells, and I get IRR of 30.58%. Okay, so there's this annoying part where we do a regular payback period calculation. I'm just gonna do this real quick because it's real easy. My net cash flows are these guys.
No está mal.
Oops, sorry.
Pues igual ya me atrasé, ya no. Pero
My net cash flows are what I just calculated. My cumulative net cash flow is what I get in the year plus whatever my initial investment amount was. So after 1 year, I paid back, I still owe 9.317 million on this. After 2 years, a little bit less. After 3 years, so you'll notice this is where it flips, right? The sign flips in years from year 2 to year 3. So my regular payback period is gonna be 2 something. I collect 6.473438 over the course of year 3. I still owed, putting in a negative sign so this turns out positive, I still owed that negative 2741243, and I'm just dividing by how much the full amount that I collect in year 3. What this means is it's gonna take me 0.42 parts of year 2 to pay back, to get us to 0 on our investment amount. So my regular payback period is 2 plus this. So 2.42 years. This is a less than useful decision rule, but, or capital budgeting technique, but it's part of your question, so I wanted to mention it. All right, any questions? You've got your base case now.
I got lost in the cumulative net cash flow.
I wanna get through the, catch me up, so, cause it's really not that important, that's why I'm not. Okay, so, but the cash flows, all the cash flow stuff makes sense, right? Okay, cash flows, NPV, IRR makes sense? Okay. Now, we're doing a sensitivity analysis. What I would suggest for this is to create a new sheet. So I've got all this, right? But they use cell references, and I want to be able to check a bunch of things. I want to be able to change a bunch of things in this. So I'm going to create a copy of this sheet and call it like sensitivity or something, right? Or we'll do the risk, we'll call it risk analysis. Because we're going to do a number of things from here. But it lets me keep this all the same so that I have all my calculations correctly with my base case. So my base case NPV is just this, right? That's what I just calculated. Now, what I want to know is, what happens if I move some variables around, right? I'm going to look at sales price, I'm going to look at variable costs, and then I think we look at units sold. So we're going to check out 3 variables and see what it does to our NPV calculation based on what if I'm 20% off either way, right? So for my sales price, I'm going to take this number, the sales price, 27,000, but I'm going to use this one because I'm going to need to change it up there. So I'm going to use the 27,000 sales price here times 1 plus this interest rate, or whatever that percentage is, right? So this is going to tell me what if my sales price is only 80% of my base case. And the next one's going to tell me what if it's 90% of my base case, et cetera, et cetera. So if it's 20% off, it'll be 21.6. If it's 10% off, it's going to be 24.3. Obviously, if it's 0% off, oops, that's something there. Sorry, there should be 2. It's going to be 27. That's my base case value, right? Paste this again. If it's 10% more, that's good, right? I can sell it for more than I thought I could. I can sell it for 29.7. And then finally, what if I can sell it for 20% more? That's going to be 27,000 times 1 plus 20%. Any questions on how I got those numbers? Okay. So what I'm going to do now is copy and paste these numbers up into my original formula. I've calculated it all so that this is referencing this number, right? So if I change this number, my full calculation gets, my NPV is completely redone, right? Everything happens. You're saying, oh my God, but it's so nice. If you set it up correctly, it works really, really well. It's pretty easy.
Like, but okay, it's fine. It's fine. It's fine. It's fine. It's fine.
Okay, so what I'm gonna do though, I'm copying 21.6. And I'm gonna right click, paste the value. Right? So I'm not pasting the cell reference. I don't wanna do that. I wanna paste just the value. This all gets updated, boom, 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 boom. And I don't have to do anything but look at the new NPV.
Okay.
Yeah? So now I'm gonna copy that, and I'm gonna, again, right click,
This is too much.
paste the value. Yeah? Make sense?
Yeah.
Okay. So now let me go back to my, actually, so I'm gonna do 27,000, right? I'm gonna make that, I'm pasting that value in there too, just so it stays constant. So I'm just gonna do that same thing with all of these numbers.
Let's use
Bless you. And for expediency, I'm actually just gonna paste these numbers, because that's what I'm doing for all of these, right? I'm gonna do that with my sales numbers. My NPV is gonna be the same for this case. This is gonna be my new, now I'm looking at variable costs, right? This is better. This is good if my variable costs go lower, right? This is actually gonna be a positive thing. So let me lock in that cell reference there.
Thank you.
So now I've got all these numbers here. I would do the same thing. I'd go take these numbers and plug them into my variable costs up there.
Yeah.
Grab the NPV, pull it into this table here. I have already done that.
Yes.
So these are my NPVs based on that. Okay, so I'm doing that same thing 15 times to get all the sensitivity and all this stuff
Oh
in
my
there. Yeah?
God.
Now you can say, oh my God.
Yeah.
Okay. Any questions though? Makes sense, right?
Yeah, it makes
You
sense.
just, if you got it set up correctly, it's super easy. I mean, it's a little tedious, but it's not hard. All right. Now, this was already set up to reference all these things, right? So I've got this table with my sensitivity analyses. I'm going to do something just to, you don't have to do this for your purposes, you can do it, well, I'll do it the way you do. Okay, so, what we want, the question is, what does the graph look like, right? You remember we talked about sensitivity analysis, we looked at how each variable affects the NPV. So what I'm doing is I'm highlighting that table here that's generated from what I just plugged in. I'm going to insert, and I would just go to recommended charts. And if you scroll down, you'll see this guy right here.
Scatter.
You are asked to say which chart is correct. You have like a multiple choice question based on the sensitivity analysis. But this is it. So there's one that looks like this. That's what you're looking for. It's just insert, recommended chart, look for the one that has these lines like this. Questions on that? Okay. Oh, we're not even done yet. Okay, so Now, we're close though, we're real close. Okay, we're actually gonna do, so that was the sensitivity analysis. Now we're looking at scenario analysis, which is we take a best case, we take a base case, we take a worst case, and we get that table that we started the class with, right? Where we have the different NPVs at each level, we get an expected NPV, then we do a standard deviation, right? So here are our best case, here's our base case, and here's our worst case. I'm gonna plug in those variables and see what they are. I'm only gonna do it for the best case. Keep this expeditious. All right, so I've got my units sold, best case is 1320. My sales price, best case is 32.4. So I'm replacing that here. And then my best case variable cost is lower at 14.8. So I'm gonna go up here and paste that in again. I end up with an NPV of 37.978, right?
Yeah.
Does that make sense? So I just took those three variables now and I put them in, my NPV was calculated.
Okay.
If I do that for all of them, this is what I end up, my base case hasn't changed, my worst case is negative 16 NPV, right?
Okay. Yeah.
Then my expected NPV is, just like we started this, some product of these numbers, and some product of, oh, not those numbers, and the NPVs. So 25% times 37 million, 50% plus 50% times 6, et cetera. My expected NPV now is 8.5 million or thereabouts. My standard deviation is same calculation I did at the beginning of this class, where it's the value minus the expected value squared times the probability. Probability there. Now we have a standard deviation, the coefficient of variation.
Yes.
It's the same formula as from before.
Yeah.
Coefficient of variation is just standard deviation over expected NPV, 2.28. In my scenario, I was told that a regular project is between a 0.7 and a 1.3. If it's lower than that, we would take some number off the WACC. I think we subtract 3. If it's higher than that, we add 2 percentage points to the WACC. So this is higher than, this is a risky project. Therefore, when it asks me what the new NPV is, it's actually going to be 16%. Yeah? Because it's a riskier project. So now my risk-adjusted NPV, what I'm going to do is go back to the original NPV scenario, and instead of using a 14% discount rate, I'm going to use a 16% discount rate. Fortunately, I've left my NPV formula on sheet 1 handily filled out from the original case, and all I have to do is change this number. I have a new NPV. That is my new expected NPV. And my IRR and my payback period are what? Do they change? They don't change because the cash flows don't change. Even though the WACC changed, the actual IRR calculation and the risk-adjusted payback period do not. And that, with 2 minutes to spare, is the whole project.
Oh my god. Que me suicido,
Ashley, that good?
So, so at the end with the same numbers, you just change like the same numbers that started the calculations. You just change the walk for the risk adjusted and
Correct. Correct.
Okay.
Yeah, so once I've done all this, right, I can calculate the CV of the project, and depending on whether it falls into my normal range, I can change the WAC. It's just a risk adjustment to the WAC.
Can you show us the formulas?
Which one?
Este es todo proyecto y le queda
Beginning.
Yeah, just to check. Because you're explaining the consultant
O sea que no,
and we want to check. Yo me quedé.
Todo lo demás I'm gonna give this.
No quiero ver si lo tengo.
I thought I had a 2, but I got it wrong. So
Yeah, I'm gonna have it wrong.
You sent us the
No.
spreadsheet.
Too easy then. I knew you're smart for asking, but no. Yeah, no, I really want you to understand what I was doing, so. But you can, like, if you hit that check work button, you can always, like, you can do it 100 times. Well, you can see the formulas, but